It is 4:41 in the morning on a Wednesday in October, outside Sacramento, California. Two Bearcat G3 armored vehicles roll without headlights down a service road behind a regional pool supply warehouse on Industrial Parkway East in Rancho Cordova. The engines are cut. 18 DEA agents in full tactical gear step onto the asphalt. Nobody speaks above a whisper. At exactly 4:43, a second strike team, 11 agents, pulls up to a chlorine storage annex 3 miles away on Sunrise Commerce Drive. 2 locations, 2 objectives, 1 countdown. At 4:44 and 30 seconds, the radio crackles. Execute. The breach team at the main warehouse hits the roll-up loading door with a hydraulic ram. 1 strike. The door folds inward. Agents flow through in a stack, weapons up, flashlights cutting the dark. Inside, rows of industrial shelving, pallets of white drums, and the sharp chemical bite of pool supply in the air. Sodium hypochlorite, muriatic acid, the ordinary smell of a legitimate business. But nothing here is ordinary. Not the inventory, not the books, not the floor safe they are about to find, bolted to the concrete beneath a false shelving unit in the northwest corner of the building. That safe will take 40 minutes to open. What is inside it will change the direction of the entire case. 47 seconds after the first team enters the main warehouse, the second team hits the annex on Sunrise Commerce Drive. 11 agents through a standard entry door. No resistance. What they find inside is not pool chemicals waiting for retail stores. It is 220 steel drums of diverted precursor chemicals, muriatic acid and sodium hydroxide, stacked floor to ceiling, tagged with falsified purchase orders. Part of a pipeline that has been moving product for 38 months without anyone outside this building knowing a thing about it. Or so the organization believed. The thread that unraveled all of it was not a wiretap, not a confidential informant, not a traffic stop or a suspicious wire transfer flagged by a bank compliance officer. It was a spreadsheet, one spreadsheet, and one chemist at a state water quality laboratory who noticed a number that did not make sense. Her name, for the purposes of this reconstruction, is Dr. Lena Marsh. She works for the California State Water Resources Control Board, reviewing annual chemical procurement reports submitted by commercial suppliers as part of a routine environmental compliance audit. It is a job that generates almost no public attention, requires deep technical knowledge, and on most days produces nothing more consequential than a minor paperwork correction. On a Tuesday afternoon in early March, about 19 months before that pre-dawn raid, Dr. Marsh is working through the procurement filings for a company called Pacific Basin Pool and Supply LLC, a legitimate-looking distributor with 14 retail storefronts spread across 4 counties in the Central Valley. The filing shows their annual purchase totals for common pool chemicals, including muriatic acid, which is hydrochloric acid in diluted form used to adjust the pH of swimming pools, sodium hydroxide, commonly sold as pH up, calcium hypochlorite, all standard inventory for a pool supply company. The numbers for most chemicals look right, but one figure stops her. Pacific Basin Pool and Supply has declared purchases of muriatic acid and sodium hydroxide at 9 times the volume that their 14 retail stores could conceivably sell in a calendar year. 9 times. Not a rounding error, not a data entry mistake. 9 times the plausible retail demand for a company of that size, in that market, with those square footage numbers on file. Dr. Marsh checks the figure twice, then she pulls the prior year's filing. The year before that. The pattern holds across 3 consecutive annual reports, each one showing precursor volumes that cannot be explained by the retail footprint of the business. She writes a 2-page technical memo and routes it to the California Department of Justice. The DOJ passes it to the DEA's Sacramento Field Division within 72 hours. That is where the case begins. One anomaly. One spreadsheet line, one chemist who noticed the math did not add up. I spent time going through the technical details of this kind of procurement analysis, and what struck me immediately is how narrow the margin of detection actually was. One regulatory report, filed once a year, reviewed by one analyst in a department most people have never heard of. If Dr. Marsh had been running behind on her caseload, if that filing had sat in a queue for another 2 weeks, the organization might have wrapped up a 4th year of operations before anyone looked twice. How do you build a narcotics trafficking and money laundering enterprise worth $137 million and hide it inside a pool supply chain? The answer, as DEA investigators would discover, is surprisingly systematic. Pacific Basin Pool and Supply was incorporated in 2019 as a legitimate business. Its 14 retail stores were real. They sold pool chemicals, cleaning supplies, testing kits, filters. They had employees, payroll, commercial leases, a website. The retail operation generated genuine revenue. Not enough to explain the financial activity in the associated accounts, but enough to make the paperwork look credible. Behind the retail front, a separate logistics structure handled a parallel operation. Bulk industrial quantities of muriatic acid and sodium hydroxide, both used as processing chemicals in cocaine-based conversion, were purchased through the company's commercial accounts under normal pool supply procurement. Under a retail pool exemption written into federal chemical scheduling rules in 1994, bulk purchases of these compounds by licensed pool supply retailers require no additional DEA registration, no usage tracking, and no volumetric reporting above the standard environmental compliance filing. The 1994 exemption was designed to reduce regulatory burden on small pool supply businesses. It made sense in 1994, for a different chemical landscape, a different distribution model, a different era of drug trafficking. 30 years later, it created a gap that a sophisticated organization could drive a fleet of cargo trucks through. The DEA's Sacramento Field Division opened a formal investigation on March 19th, 16 days after Dr. Marsh's memo landed on their desk. The lead case agent, identified here as Special Agent David Calloway, had spent 9 years in financial crimes before transferring to drug enforcement. He understood money before he understood drugs, and that background would prove to be exactly the right lens for this case. Calloway's first move was not surveillance. It was forensic accounting. He requested 3 years of financial records for Pacific Basin Pool and Supply and its 4 known subsidiary LLCs through a grand jury subpoena. What came back over the following 6 weeks was a financial picture that, on the surface, looked functional. The 4 shell companies, registered in California, Nevada, Arizona, and Texas, showed activity consistent with a regional distribution business. Vendor payments, lease agreements, payroll cycles, state tax filings, insurance premiums. Clean, professional, documented. But the cash flow was off. Retail pool supply is a credit card and check business. The kind of business where a busy Saturday in July might bring in $3,000 across a busy store. The financial records for Pacific Basin and its affiliates showed recurring cash deposits, structured in amounts between $8,000 and $9,000 to stay below the $10,000 federal currency transaction reporting threshold, across accounts at 6 different financial institutions. A pattern called structuring. And structuring is a federal crime. Calloway brought in a financial intelligence analyst from DEA's El Paso Intelligence Center, EPIC, to build a transaction map. Over the next 2 months, the analyst traced 212 separate structured deposits across 4 states, totaling just over $18 million in the first full accounting pass. That number would grow. Here is the part that doesn't make sense on the surface. The organization was being meticulous. They were filing state tax returns, paying their retail employees on the books, maintaining legitimate vendor relationships with actual pool chemical manufacturers. On the outside, Pacific Basin looked like a slightly boring regional business, going through ordinary ups and downs. The sophistication wasn't in flamboyance. It was in the deliberate cultivation of normalcy. 3 months into the investigation, Calloway needed something closer. A source inside the logistics operation. He needed a confidential informant. Finding a CI inside a closed, family-structured organization is one of the hardest operational tasks in law enforcement. The organizations that last don't hire strangers. The people inside them have personal, financial, and sometimes coercive reasons to stay quiet. Calloway's team spent 6 weeks developing potential sources from the periphery. Former employees, vendors with grievances, associates who had been cut out of the money and knew it. The person they eventually landed was a logistics coordinator who had worked in the warehouse office for 14 months. For the purposes of this reconstruction, call him Marcus. Marcus had no prior criminal history and had taken the job as a dispatcher and receiving clerk without knowing the full nature of what the business was actually doing. By the time he understood the scope of the operation, he felt trapped. When DEA approached him, carefully, legally, through an attorney, he chose cooperation. Marcus was not asked to take risks. He was not wired for confrontations. He was asked to do his job, document what he saw, and relay scheduling and shipment information to his DEA handler through a pre-arranged protocol. What he provided over the next 14 months was a continuous operational picture: delivery schedules, drum counts, the identity of a mid-level logistics manager who coordinated between the front company and the actual processing pipeline, and the locations of 2 off-site storage facilities used to stage precursor chemicals before transfer. One detail that stuck with me, reading through the layered account of Marcus's 18 months inside that warehouse, is the mundanity of it. He sat at a desk, he answered phone calls, he filed manifests, and every few days he noted in a secure log that another shipment of drums had moved to a destination that had nothing to do with any swimming pool anywhere. But Marcus nearly ended the investigation before it could reach a conclusion. In month 9, roughly midway through the undercover phase, the logistics manager, identified here as Victor Reyes, told the warehouse staff that the company would be conducting an internal security review, new ID badge protocols, new access logs for the back storage area. A security consultant brought in for 2 days to walk the facility. Calloway's team went into emergency protocols. For 72 hours, Marcus was told to reduce all non-essential contact to 0. He was instructed to appear entirely routine, clock in, work his shift, clock out. The DEA could not pull him without potentially tipping the organization that something had changed. Pulling him would burn the investigation and give the organization time to move assets before warrants could be secured. Leaving him in place carried its own risk. The security review found nothing. The consultant was apparently looking for inventory discrepancies and employee theft, standard retail sector concerns, not a federal informant with a memorization protocol. Marcus cleared the review without incident, returned to normal contact with his handler 48 hours later, and the investigation continued. That was the closest it came to falling apart, and that near miss reshaped how the team managed Marcus for the remaining months of the operation. More distance, slower cadence, more patience. What do you think? When the security review started, was there a point where the right call was to pull Marcus and file charges on what they already had, or was the additional intelligence worth the risk? That question came up in every review of this case, and reasonable people in federal law enforcement still disagree on the answer. Alongside the CI operation, Calloway's team had obtained pen register orders on 11 phones associated with Pacific Basin leadership, a legal tool that captures call metadata, numbers dialed, duration and timestamp without recording the content of conversations. Over 8 months, the pen registers mapped a communication pattern between the warehouse management structure, 2 external contacts in Arizona, and a financial coordinator based in the Las Vegas area whose role was tracing the layered cash back into business accounts through invoice manipulation. The financial coordinator, call him Elliot Drace, was the architectural center of the money laundering structure. Drace maintained the 4 shell LLCs, managed the relationships with the financial institutions, and generated the false invoices that gave the structured deposits a paperwork basis. He was meticulous. He used encrypted messaging apps for sensitive discussions and a separate phone for routine business calls. He rarely visited the warehouse. Finding Drace took most of the first year. The pen register data showed a recurring contact number in the 702 area code that appeared on warehouse management phones at irregular intervals. It took 4 months of subpoenas and financial record requests to work backward from that phone number to a natural person, and another 6 weeks of verification to confirm that the person attached to that number was actually running the financial architecture of the operation. Here's a take that will probably get us some pushback. The regulatory gap that made all of this possible, the 1994 retail pool exemption for bulk chemical purchases, has been flagged in DEA internal assessments at least 3 times in the last 15 years. Not once has Congress moved to close it. We'll say what most won't. That's not bureaucratic inertia. That's a choice. And cases like this one are the price of that choice. By month 17, the case had layers. The DEA had a financial map of 4 shell LLCs, 212 structured deposits, totaling what had now grown to an estimated $74 million through the end of the prior fiscal year, with projections suggesting the total would cross $100 million before the investigation concluded. They had Marcus's logistics intelligence. They had the pen register communication map. They had forensic analysis linking the precursor chemical purchases to volumes consistent with the processing of 6.2 tons of finished product over the 38-month operational window. What they did not yet have was a direct link, admissible evidence tying the chemical diversions to a specific product output at a specific location. They needed that link for the conspiracy counts to hold under federal sentencing guidelines. Without it, the money laundering case was strong, but the drug trafficking charges, which carried the sentencing weight that the prosecution needed, had gaps. The break came in month 18. Marcus reported that a new shipment protocol was being set up for the following month. Instead of the normal transfer of drums to the off-site staging facility, the logistics manager had arranged for a direct delivery. Drums going straight from the Pacific Basin Annex on Sunrise Commerce Drive to a third-party commercial address in Elk Grove. The address was new. It had not appeared in the pen register data or the financial records, and the delivery was scheduled for a Tuesday afternoon in October. Calloway's team placed the Elk Grove address under physical surveillance. 2 agents in a panel van, rotating with a third vehicle, watching a commercial unit in an industrial park on Grant Line Road. On Tuesday, October 11th, a cargo van matching the description Marcus had provided pulled up to the Grant Line Road unit at 2:17 in the afternoon. 2 men unloaded 14 drums. The van left. 12 minutes later, DEA surveillance captured the commercial unit's occupant, a person not previously identified in the investigation, receiving the delivery and signing a manifest. That signature, matched through a database query to a known associate with a prior controlled substances conviction, was the evidentiary link the case had been missing. It tied the precursor chemical pipeline from Pacific Basin's annex directly to an individual with a documented nexus to drug processing. The case was ready. Calloway presented his package to the U.S. Attorney's Office for the Eastern District of California on October 14th. Prosecutors spent 11 days reviewing the affidavit package. Over 300 pages of financial records, surveillance logs, pen register analysis, CI reporting, and forensic chemistry assessments. On October 25th, a federal magistrate judge signed search warrants for the Pacific Basin main warehouse, the Sunrise Commerce Drive Annex, the Elk Grove Commercial Unit, the corporate offices of all 4 Shell LLCs, 3 residential addresses associated with senior figures in the organization, and a safety deposit box at a bank branch in Folsom registered under one of the LLCs. Arrest warrants were issued for 22 individuals in the first wave, with sealed indictments covering an additional 29 named in the conspiracy and money laundering counts. 51 total. The operation had a strike date, Wednesday, October 28th. Execution at 4:41 a.m. Here is what the 18 DEA agents found when they entered the main warehouse on Industrial Parkway East in those first minutes after breach. 41 drums of muriatic acid and sodium hydroxide staged near the loading dock, prepped for a scheduled Wednesday delivery that would never happen. Pallets of legitimate pool supply inventory covering the rear of the building. A logistics office in the southeast corner with 3 desktop computers running inventory management software. And in the northwest corner, beneath a false shelving unit bolted to the floor, a floor safe, commercial grade, steel reinforced, containing $2,100,000 in banded cash. The safe took 40 minutes to open, with a cutting tool brought in by the breach team. When the door finally came free, a DEA evidence technician counted the cash in stacks on the warehouse floor. 42 minutes after the breach, the total was confirmed, $2.1 million. A single float, ready cash held at the warehouse, probably for a pending transaction the organization had not yet completed. At the Sunrise Commerce Drive Annex, the second team secured 220 drums and arrested 3 individuals who were on site when agents entered. All 3 were later named in the indictment. By 7:15 that morning, 14 arrest warrants had been executed across the Sacramento metro area. By 3 p.m., 21 of the 22 primary targets were in custody. The 22nd, a financial associate believed to have been in Phoenix on the day of the raid, was arrested by DEA Phoenix Field Division 41 hours later at a private residence in Chandler, Arizona. Victor Reyes, the logistics manager, was taken at his home in Citrus Heights at 5:02 a.m. He opened the door in response to a knock and was in handcuffs within 30 seconds. Elliot Drace, the financial coordinator in Las Vegas, was arrested at 6:19 a.m. by DEA Las Vegas with Clark County Sheriff's Department support. He was in the middle of a phone call when agents entered through a door his building manager had unlocked, pursuant to a federal warrant. The phone was seized as evidence. By the end of the day, the numbers looked like this: 51 individuals indicted on charges including conspiracy to distribute a controlled substance, money laundering conspiracy, structuring of financial transactions, and possession of listed chemical precursors with intent to manufacture. The charges carried combined maximum exposure of decades in federal prison for the senior figures. 6.2 tons of finished product, the estimated output of the 38-month pipeline, based on forensic chemistry assessment of the precursor volumes processed. 220 drums of diverted industrial chemicals, with an assessed street value impact on the cocaine supply chain running into the tens of millions of dollars per processing cycle. 14 Pacific Basin retail storefronts shuttered by court order on the day of the raid. 22 financial accounts across 4 states frozen by federal asset forfeiture action. The 4 shell LLCs dissolved by court order within 10 days of indictment. The total financial footprint of the money laundering conspiracy, as assessed by DEA forensic accountants and prosecutors, $137 million, moved across 4 states over 38 months, through a structure built inside a pool supply business that sold chlorine tablets and pH testing kits at retail. We track what comes next. Subscribe to the Bureau Files so the next case finds you first. What strikes us about this case, genuinely, is not the scale of what was seized. It is the architecture of ordinariness that made it possible. Pacific Basin Pool and Supply had real employees who had no idea what they were working inside. Real customers who bought real pool chemicals at real stores. The infrastructure of legitimacy was not a thin veneer. It was the actual business, running in parallel with the criminal operation, each one reinforcing the credibility of the other. And at the center of it all, a chemical procurement exemption, written for small pool supply businesses in 1994, when muriatic acid purchases by a retail chain were a compliance footnote, not a trafficking vector. The exemption is still on the books. The threshold that triggered Dr. Marsh's review, the 9 times over purchase volume, is not itself illegal under current federal rules. What is illegal is what the chemicals were ultimately used for, but by the time the illegal use can be documented, the pipeline has been running for years. Here is the question this case leaves open. How many other ordinary supply chains are moving extraordinary volumes of regulated materials through exemptions that haven't been reviewed since the Clinton administration? Who is auditing the gaps that were written into law before the trafficking methods that exploit them even existed? The floor safe from the main warehouse, evidence item 001-A in the case file, is now in a federal evidence facility in Sacramento. $2.1 million in banded cash, removed from a commercial building that sold chlorine tablets to swimming pool owners. It sits on a shelf in a federal storage bay, tagged, photographed, and cataloged. The money is gone, the network is dismantled, but the exemption that made the whole thing possible is still exactly where it was on October 27th, the night before the raid, sitting in a federal regulatory code, unchanged, waiting for the next organization clever enough to read it carefully.